Portugal is one of Europe's most scrutinized economies, NATO member, Eurozone, A-rated by every major agency. And on April 9, 2026, it walked into a market denominated entirely in Chinese yuan and borrowed nearly 2 billion of them. This isn't a BRICS country, this isn't a summit photo, this is a sovereign debt decision made by a government accountable to Brussels, Washington, and its own bond market. When A-rated Eurozone sovereigns start routing borrowing through Chinese currency infrastructure, the map changes. Here's what doesn't make sense. Portugal has the best credit ratings in over a decade. It doesn't need to do this. And yet, its own debt office says it did it because yuan was cheaper, nearly half the interest rate of equivalent euro debt on the exact same day. By the end of this video, you'll understand why one bond prospectus from Lisbon tells you more about the future of de-dollarization than any BRICS summit ever will.
You're watching Voice on Pages, where capital logic replaces capital noise. Subscribe if you think in systems.
The math here is forcing a massive pivot, and to understand why, we have to look at the cognitive dissonance between the geopolitical narrative we hear every day and the actual financial reality playing out on trading floors. A sovereign state with an absolutely pristine credit standing just deliberately sidestepped its own currency to secure financing in a completely different monetary ecosystem. Look at Portugal's fiscal trajectory. Back in 2020, their debt-to-GDP ratio was sitting at around 135%. But by 2025, they wrestled that figure all the way down to a very clean 89.7%. They've earned an A+ rating from S&P, an A3 from Moody's, and an A from Fitch. So, we need to be crystal clear about something right up front. This wasn't some act of desperation from a distressed borrower locked out of traditional markets. Not at all. This was a highly calculated, strategic decision by a European finance ministry acting from a position of absolute strength. The entire rationale reveals itself directly in the pricing. On April 9th, Portugal's 8-year sovereign debt yield in the euro market was hovering right around 3.2%. But the coupon on their new offshore yuan bond, that was priced at just 1.765%. To put that into perspective, think about qualifying for a mortgage at your local bank's absolute best rate, and then finding another lender who's willing to offer you the exact same 8-year term for roughly half the interest. A spread of around 145 basis points is just mathematically impossible to ignore. You switch lenders because the math dictates it, and that's exactly what Portugal's debt office did. And Portugal's own debt management agency, the IGCP, actually went on the record to confirm this. Even after they executed all the necessary interest rate and foreign exchange hedges, literally neutralizing the currency risk entirely, the all-in costs were still significantly lower than their comparable government bonds trading in the secondary market. They fully hedged the risk, and the Chinese currency still provided a vastly superior cost of capital. This transaction is absolutely crucial because it exposes how currency dominance actually shifts in real time. We have to remember that the US dollar didn't become the global reserve currency simply because of political declarations or grand speeches. It built that status through unglamorous financial plumbing, clearinghouses, deep liquidity, and undeniable everyday utility. And the Chinese yuan is methodically laying down that exact same architecture, one sovereign borrower at a time. This isn't just an isolated anomaly. What we're looking at is a sequential, accelerating trend of European Union sovereigns embedding themselves right into Chinese currency infrastructure. Poland was actually the first European sovereign to issue a panda bond. Then Portugal tested the waters with an onshore yuan bond back in 2019. Hungary followed up with a green sovereign panda bond in December 2021. And now Portugal has crossed a massive new threshold, entering the offshore dim sum market and directly connecting a euro area sovereign to Hong Kong's clearing architecture. And this brilliantly illustrates the sheer momentum within this specific ecosystem. The offshore yuan, or dim sum market, has seen 8 consecutive years of massive expansion. It went from about 300 billion yuan in 2021, surging well past the 1 trillion mark in 2024. Right now, total outstanding offshore bonds are sitting at around 1.8 trillion yuan. This is a deep, highly liquid market that Western institutions are increasingly tapping into to optimize their balance sheets. So, what does this all mean for the rest of the world? Well, a move of this scale instantly alters the strategic calculations for other global players. When a foundational Western nation optimizes its debt through Chinese markets, the geopolitical geometry changes practically overnight. And nowhere is that calculus being watched more closely than in New Delhi. Consider this. India and China reached a record bilateral trade volume of $155 billion in 2025. That's up more than 12% year on year. Yet, almost none of that massive trade is settled in yuan.
The Reserve Bank of India has been aggressively building up rupee settlement infrastructure for the explicit purpose of avoiding this exact kind of Chinese currency dependency. They even went so far as to actively discourage Indian banks from using yuan for Russian payments back in 2023. But Portugal's recent move completely changes the baseline math. India's gift city is now quietly exploring offshore CNH transactions. Something that was considered a fringe idea before April 9th is suddenly becoming a matter of competitive financial necessity, forced by pure market mechanics. Now, here's the profound irony in all of this. Beijing isn't the sole or even the most immediate winner in this arrangement. The structural beneficiaries of yuan internationalization are actually the Western financial centers. They're the ones actively profiting from, and frankly, enabling, this entire shift.
Now, what's really interesting about the slide is the cast of characters. It reveals a global network actively in motion. Hong Kong is solidifying its role as the primary offshore clearing hub, a position it's held since 2007. Every offshore yuan bond flows right through their infrastructure. Then you have the Luxembourg Stock Exchange, which remains the largest listing venue for these bonds anywhere on Earth. Germany's KfW utilizes Frankfurt's clearing infrastructure for its own 1 billion RMB dim sum bond. And the lead arrangers, the ones actually earning the fees on Portugal's landmark deal, that would be China's largest state bank, ICBC, co-leading the deal right alongside Germany's Deutsche Bank. Western financial heavyweights, institutions like HSBC and BNP Paribas, are quietly and methodically constructing the plumbing for the yuan's global ascent. And they aren't doing it out of ideology, and they certainly don't need a BRICS summit to make it happen. They're doing it for yield, for market share, and for the fees. Capital doesn't follow safety. It follows logic over loyalty. Zooming out to the macro perspective, this reveals a direct line to the defining financial pivot of the 20th century. We are witnessing a forensic, almost identical parallel to how the current global monetary system was originally established. Think back to the 1970s. The petrodollar recycling system embedded the US dollar into sovereign balance sheets all across the globe. And crucially, it didn't happen through force. It happened through undeniable cost logic and incredibly deep liquidity. Within a single decade, the entire architecture was permanently set. Today, offshore yuan borrowing is following that exact same blueprint, offering superior funding costs to pristine European borrowers. The infrastructure of a multi-currency world is already fully constructed. It's not waiting around for a geopolitical shock or some grand treaty to be signed. It's hiding in plain sight, completely codified within the bond prospectuses of European finance ministries. The question was never whether this would happen. It was who would notice before the architecture was already built right around them. Because in the end, capital doesn't have loyalty, it has logic.